QuickBooks Pro Desktop 2021. Forward contract for speculation that foreign currency will weaken, adjusting entry. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in our problem 3 multiple currencies practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. Last time we entered the initial transactions into the system for our forward contract. Let's take a look at that now by going to the reports dropdown. Company and financial, take a look at the balance sheet standard. Balance sheet standard, changing the dates up top and the customization of the reports from 01/01/21 to 12/31/21, January through December 2021. We now have on the books, we have the receivable on the books at the 3,700 and the payable on the books for the 3,700 as well, noting that the payable is going to be paid in foreign currency, which we should probably label in the account. I'll actually adjust that account name so we could see it in the account name over here by going to the lists drop down. Let's take a look at that chart of accounts, and I'd like to see the payable. So the payable to the exchange broker. Let's go ahead and edit that, right clicking on that, edit that one, and I'm going to put at the end of the name that this is going to be in the MXN. I also renamed the receivable by right-clicking on the receivable, editing the account, and this one's going to be in the US currency, so I'll just label that as USD, US dollars. So then I'm going to save and close that. We're going to go back to the balance sheet. Back at the balance sheet, we could see that we have these labels now showing up, and we could see then that we're going to be concentrating on the payable, it then being in the current foreign currency, something that we will be paying in the foreign currency. So as of the cutoff date, as of the end of the year now, we need to be updating this item to the current rate that needs to be used as of the end of the year, recognizing any gain or loss at that point in time. Let's first take a look at that in Excel. So within Excel, if we scroll on down, we then have the 5,000 that we're going to pay in the Mexican pesos in the future. So we need to value that in terms of US dollars as of the cutoff date, as of the end of the year. So we're going to be taking then the 5,000 pesos. We're going to multiply that times the forward rate. Once again, we're not using the spot rate because now it's a later point in time, but we're not to the point in time where the end of the contract is. And so we're trying to project out to what we believe the spot rate is at the end of the contract. It's still kind of a market determines that speculation, but it's not the actual spot rate as of the point in time because we don't know it yet. It's a speculative rate. And then next time when the contract ends, we'll use the actual spot rate because we will be focused at the point that we've been looking towards for this whole contract. So we're then going to be multiplying that times 0.78, and that'll give us the 3,900. If I take the 3.9 minus what's currently there, the 3.7, we have a $200 difference. The $200 difference is going to be increasing the payable that we have, which is typically kind of bad, right? We'd say, okay, the payable is going up. Why would that be the case? Well, before we had $1 could be purchasing 1 peso could be purchasing $0.74. Now we're saying 1 peso can purchase more fractions of a dollar, 0.78. Therefore, the peso got stronger, and we're talking about valuing something that we have as a payable here, meaning we're going to be paying in pesos, and the fact that they have gotten stronger means we're going to be paying something that has more purchasing power than we thought it did when we made the contract. So the speculation doesn't look to be good thus far. Let's go ahead and record this out. We're going to say then that we're going to have to increase that, so it's going to have a loss on top. So we're going to pick up the loss, foreign transaction loss, and then the other side is going to be the payable. So the payable, foreign currency payable, and then I'll do the calculation again. This way, this equals, and I'm going to take the larger number minus the smaller. So I'm going to take, so it's a positive number, the 0.78 minus the 0.74, closing up the brackets, times the 5,000. That then will give us, once again, the $200. There's the debit, there's the credit. If we post this out, then we're going to have a loss thus far on our currency transaction, but it's not over yet. You know, we've made a bad guess so far, but we got 180 days. So then the other side is going to be the foreign currency exchange. So here it is. Here something's in it, so I'm going to double click on it to go to the end of it and say plus. Pick up that 200, which should bring the payable back up to that 3,900. That 3,900 once again is, if I scroll back on over, 3,900 is the 5,000 that we're going to be paying in the future times the current rate that we're using, which is the forward-looking rate of 0.78. There's the 39 that we had here. So now let's go ahead and record this in QuickBooks. So in QuickBooks, to do this, I'm going to go on back over to QuickBooks. Notice we did not have to revalue the receivable. We're just looking at the payable down here. Now, if I go back to the home page and just consider the payable, we entered basically a bill. When we get to the end, when we pay the bill, it'll basically do the calculation for us for the gain or loss. However, we have this interim period where we have to make it right as of the middle, as of our cutoff date. So what we would like to do is an adjusting entry and then a reversing entry. So we can use basically the system to help us with that instead of just manually inputting the journal entry. We could go to the lists drop down. We can take a look at the currency lists. And then if it was in real time, we still couldn't use the spot rates, meaning even if it was real time and I went to the activities and downloaded the latest exchange rates, I couldn't use the latest exchange rates because those would be the spot rates as opposed to the forward-looking rates. However, I can manually put in the rate that I'm going to be using for this particular transaction into the foreign currency. Now, I want to be careful of that because if I'm using some other, like the same peso for some other transactions, then I want to make sure that I'm using the right rate, spot rate versus the forward rate. But here I'm going to go ahead and say that this is going to be for 12/31/21, and the rate that we're going to be using is the 0.78, and then I'm going to go ahead and say OK on that. And then I would like it to record an adjusting entry to the payable, which is in that foreign currency as of the cutoff date as of 12/31. So I'm going to say activities rise up, and we want to say then that I'd like to make an adjustment. Adjustment, please, as of 12/31/21, and we want to do it for the foreign currency of the peso. And so there's the rate that we just put in place. Go ahead and calculate. And there we have it. So I'm going to check this one off. We have the exchange broker, the 5,000 that we're going to be paying in the Mexican peso. Prior balance 3,200, current balance 3,900. Difference adjustment, what will be recorded, the journal entry being created using the number of 200. Let's go ahead and say yes, save it, and close it. And then we'll check it out. Saved, closed, checking it out by going to the balance sheet now. I'm going to say don't show me that again, and yes. And then we have the payable, double clicking on the payable. We then have the 3,700 bill that we put in place, the journal entry marked here by a journal entry. If we double click on it, we can see that it is just a journal entry that was generated by the system. So that looks good. Other side on the P&L, profit and loss, income statement. Let's open that up by going to the reports drop down, company and financial, profit and loss, P&L, income statement. Changing the dates up top from 01/01/21 to 12/31/21. We then see the $200 on this side as well. Now, what we're going to have to do in the future, if I go back to the home page, is we will have to then have a payable. And when we do the payable, it will usually calculate the gain or loss. So I'd like to be able to have the two rates at these 2 points in time and then let the payable basically calculate the difference when we calculate the payable. But to do that, we're going to need to do a reversing entry in the middle. This reversing entry kind of messed that up. So I'm going to have to reverse it. I'd like to enter it now, and then I'll reverse it the first day of the next period. So we'll do that at some step as we go forward. So we're going to have to basically reverse the payable, and then of course at the end of the contract we will have the bill pay at the end, which will also be a different exchange rate date. That time we can use the spot rate, and we'll have to calculate the gain or loss that should be in the second year of operations versus this first year because it went over the cutoff period.